Hey everyone, Coach Investor back on our earnings video for today. So now that Verizon and AT&T have both reported their quarterly earnings, we can look at them in one video and compare both of them. Now, of course, both stocks have done horribly for investors for years and years. I think Verizon is now back to prices not seen since 2010, 2011 or something like that. Horribly. But of course, you buy those companies because of the dividend. Now, at the start of this year, there was a lot of fear that the dividend would not be safe, that they would have to cut dividend. And so, what's the point in buying those stocks? Well, last quarter, they already shown us that the dividend is pretty safe. And this quarter, yet again, it reaffirms my position that the dividend is safe because both companies have increased their own guidance when it comes to free cash flow. That's always great to hear. And yes, both companies still have a lot of debt. That's something you have to monitor as well. Now, looking at both stocks, comparing their valuations today to the 5-year mean, we can clearly see that today it is way cheaper for Verizon and AT&T, way below their 5-year mean when you look at price to earnings, EV to EBITDA, price to sales, and price to free cash flow. Now, by the way, this is in the next 12 months, not in the last 12 months, besides the price to free cash flow. But, I mean, the trend here is pretty clear. You're buying a stock that is paying a very high dividend. For example, AT&T dividend yield 7.4%. I believe Verizon is not that far from that number either. The stock has been hit quite hard. Year to date, it's down 13%, but as you will see in a bit, it's down quite a lot since its highs. For example, Verizon, it's down 47% since the highs back in 2019 and 2020. Now, like I said, the price right now, we're back at what, $32.5, which was the price back in 2010. As for AT&T, the stock is down 54% since its highs back in 2016. And today the price is at $15, which is the price not seen since 2003. Yes, you heard this right, 20 years ago. Now, of course, there are many reasons why this has happened. We've talked about that in the past. One of the main reasons, huge investments in 4G, in 5G throughout all these years. It demands a lot of capital investment, take on debt, etc., etc. Then there is, of course, increased competition as well. We've talked about T-Mobile. We've talked about the rumors that maybe Amazon might partner up with another service which could hurt their own numbers. Then there was this whole scandal with regards to the LED cables. I mean, the stories goes on and on and on. But currently, purely looking at the business, purely looking at this as a dividend play, in my opinion, it is a no-brainer. Now, let's have a look at their earnings report. If you enjoy this type of videos, leave it a thumbs up, subscribe if ever not. We're on our way to reach 30,000 subscribers, so thank you very much for all the support. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. So first up, Verizon. I'll show you a couple of things. We're going to go and look at the infographics because that's way easier to understand. So total revenue is down 2.6% year over year. I believe the market was expecting to be down around 3% or so. So spot on or close to spot on. But we can see that the bleeding has stopped here. It has gone down in Q1, in Q2, but now it has reaccelerated a little bit in Q3. With regards to total wireless service revenue, that keeps on increasing quarter over quarter and is up 2.9% year over year. And so if we look at the overall performance, the overall numbers, so total consolidated revenue, $33.3 billion, adjusted EBITDA, $12.2 billion, which is basically flat year over year, and adjusted EPS, $1.22. That's a 7.6% decline year over year. But if we look at the cash flow summary, cash flow from operation, we increased a little bit from 2022. We're now at $28.8 billion. CapEx decreased from $15.8 to $14.2 billion. Then free cash flow increased by more than $2 billion year over year. And dividend paid went from $8.1 billion to $8.2 billion. So again, here you can clearly see the dividend is safe. As for the revenue breakdown, $19.3 billion come from wireless service, $25.3 billion total consumer, and $7.5 billion total business. With regards to the operating metrics, broadband net addition of 434,000. There were 143.6 million wireless retail connections, over 100,000 wireless postpaid phone net addition, 1.15% churn when it comes to the wireless retail postpaid, and 0.9% wireless retail postpaid phone churn. And now, as for their guidance, so for 2023, they now expect cash flow from operation in the range of $36.25 to $37.25 billion, capital spending at the higher end of the previously guided $18.25 to $19.25 billion, and free cash flow above $18 billion, a $1 billion increase from the previously issued guidance. In addition, in 2023, Verizon continues to expect the following: total wireless service revenue growth of 2.5% to 4.5%, adjusted EBITDA of $47 to $48.5 billion, adjusted EPS of between $4.55 to $4.85, and the adjusted effective income tax rate in the range of 22.5 to 24%. So overall, when it comes to Verizon, in my opinion, a pretty good quarter, especially after all the noise we've had for the last couple of months. Then moving on to AT&T. With regards to AT&T, couple of comments here. So our investments in best-in-class 5G and fiber connectivity are fueling our growth engine. We're gaining profitable customer relationships and becoming more efficient. This is powering our strong business performance and gives us the confidence to raise our full-year free cash flow guidance. We are pleased that customers are choosing AT&T and staying with us over the long run as we connect and simplify their digital world. Of course, there are also talks about, well, right now in the tough economic environment, maybe not as many people will go and upgrade their phone or their phone plans, whatever, to buy the new iPhone, new Pixel, new Samsung. Usually there are deals with the likes of AT&T and Verizon. Maybe that might impact their business as well a little bit. Remains to be seen. Currently, the reports right now are still pretty positive. Jumping into the highlights here. So with regards to AT&T 5G US postpaid, they added more than 500,000. Phone net adds 468,000. Phone churn of 0.79%. Phone ARPU, average revenue per user, 55.99. That's up 0.6%. With regards to AT&T Fiber, subscribers 8 million. They added close to 300,000. They have around 26 million location passed. 39% consumer penetration, and AT&T Fiber ARPU is at $68.21. That's up 8.9%. And then here with regards to the operations. So revenue, $30 billion, which basically flat-ish year over year. Adjusted EBITDA increased $489 million. That's due to mobility and fiber growth. With regards to reported earnings per share, 48 cents compared to 79 cents same quarter last year, and this includes around $600 million in severance charge. As for cash from operation, that increased $200 million year over year to $10.3 billion. Capital investments decreased from $6.8 billion to $5.6 billion, and so free cash flow here increased from $3.8 billion to $5.2 billion. So here again, you can see that the numbers are much better than what you might have thought if you only read the headlines in the last couple of months. Now, of course, when you buy those companies, don't expect to see revenue growth or even EPS growth of double digits or high single digits. No, that's just not going to happen. But what you are looking for is improved cash from operations, improved free cash flow. That way they can keep on paying you a nice fat dividend, but also repay that large chunk of debt that they still have. That's just my opinion. I personally own Verizon in my dividend portfolio. You can find that portfolio in my pinned tweet on X, my pinned post on X. Of course, I know these two companies are, let's say, controversial because the stock hasn't really done much in years and years. A lot of people would like to go with T-Mobile, but I'm just talking here about a pure dividend play. I think, in my opinion, these two are a no-brainer. But of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.